Today we will have a look at two REITs that you should consider buying for the 2023 bull market. One of these REITs focuses on providing medical real estate, while the other focuses on providing science and technology facilities. So without further ado, let's get straight into the video. And the first company we will have a look at today is Medical Properties Trust, ticker MPW, which is currently trading at $9.18 and is up by 19.53% over the past month. This huge growth was caused by the statement MPW made just a few days ago, announcing the closing of sales of 7 Australian hospitals for 730 million Australian dollars. Now, this additional liquidity provides the very needed flexibility for MPW in the current market, prompting investors to feel safer when investing into the company. And of course, when we jump to tip ranks, MPW is currently rated a moderate buy, with a 25.27% upside and analysts predicting a price of $11.5 by the end of 2023, with the highest price target of $15 by the end of the year. Now, to value MPW in a bit more depth, we'll jump over to our fully automatic stock valuation spreadsheets, where we will have a look at the 9-pillar analysis and calculate the intrinsic value of MPW using the historical price to FFO model, multiples valuation model, and the dividend discount model, where all these models will lead to our ultimate valuation at the end of the video. Now, when we jump back to the stock screener, right away we can see that the current dividend yield for MPW is sitting at 12.64%, and the dividend payout is $1.16 per share per year, with a trailing payout ratio of just below 80%. Now, take into account that by law, REITs have to pay a high percentage of their earnings to their investors via dividends, and that is why the very high trailing payout ratio. Now let's move to the 9-pillar analysis, and here is where we have all the important metrics an investor should consider when buying a REIT. The first metric is the 5-year price to FFO, which we want to be below 20, and as we can see, MPW's is sitting at 10.24, so that is a tick. We also want there to be net income, revenue, and FFO growth over the past 5 years, and as we can see, MPW has been increasing all three steadily over the past 5 years. Now, we ideally want there to be a decrease in shares outstanding. That has not been the case with MPW, and therefore this is a cross. Now, a big red flag I see with MPW is their long-term liabilities of their 5-year FFO negative dividends sitting at 12.21. Now, what this essentially means is that MPW would take about 60 years to pay off all their long-term liabilities using their current FFO. Now, the final metric we want to look at is consecutive dividend growth, and as we can see, MPW has been growing their dividends by about 3.44% annually every single year, and if we jump to Seeking Alpha, we can see this through the 10-year graph. Now let's jump to our first valuation model, which is the historical price to FFO model. Here we take the historical price per share and the historical FFO per share and calculate the historical price to FFO, which we compare to the current price to FFO. And of course, as the current price to FFO is quite lower than the historical average price to FFO, we get an intrinsic value which is higher than the current trading price of the stock, sitting at $14.77. Now jumping to our second valuation model, the multiples valuation model. Here we compare MPW to companies which operate in the same sector, in this case DOC, HR, and OHI. We take these companies' current stock prices and their FFOs per share and calculate their price to FFO. We then average that out and compare it to the price to FFO of MPW, and of course the intrinsic value comes out to be 29.19, showing that MPW might indeed be undervalued compared to companies which operate in the same sector. Now moving to our last valuation model, the dividend discount model. Here we take dividend payout over the past 5 years and calculate the average growth rate to be sitting at 3.79. Now, due to the very high long-term liabilities we saw in the 9-pillar analysis, I project a growth rate of only 1.5%. And as we can see, when we take into account the next year's dividend and the WACC of the company, we get an intrinsic value of $27.55. Now, as I have stated before, I really do believe that the long-term liabilities MPW is currently sitting at will push it to decrease their dividend increases. And as the dividend discount model is based on valuing the company based on steady dividend growth, we will use the alternative model instead. Here we take the next year's dividend, the stock price next year predicted by analysts, and the WACC of the company to get an intrinsic value of $14.23. Now when we jump to our ultimate valuation, we average out the three valuations we did prior and get an ultimate intrinsic value of $19.39, more than 100% higher than the current trading price of the company. Now, even if we plug in a margin of safety of say 40%, that would still be a buy at the current trading price of MPW. Now the second REIT I want to show you today is Alexandria Real Estate, ticker ARE, which is currently trading at $115.45 and from its all-time high is down by more than $100. IRE is uniquely focused on cultivating life sciences, agricultural technology, and advanced technology campuses that provide their tenants with highly dynamic environments. And of course, when we jump to tip ranks, ARE is currently rated a strong buy by the analysts with 6 buy ratings, 0 hold ratings, and 0 sell ratings, with the analysts having a 40.47% upside, predicting a price of $162.17 by the end of 2023. Now jumping back to our stock screener, we will plug in the ticker ARE and all the metrics will show up automatically. And right away we can see that the current dividend yield is sitting at 4.30% with a dividend payout of $4.96 per share per year and a trailing payout ratio of more than 100%, which essentially means that ARE is going into debt when paying for their dividends, which of course isn't good. But moving to our 9-pillar analysis, we can see that ARE currently has a rating of 7 out of 9, with their 5-year price to FFO sitting at 17.89, worse than MPW's but still sitting below 20. We can also see that their 5-year profit margin is sitting at 70.87%, and their net income, their revenue, and their FFO have all been increasing over the past 5 years. But again, similarly to MPW, their shares outstanding have not been decreasing over the past few years. But if we have a look to the right, we can see that their long-term liabilities or their 5-year FFO negative dividends is sitting at 4.08, which means that they can pay off most of their long-term liabilities in about 20 years using their current FFO while paying out their current dividend. And finally, we want there to be consecutive dividend growth over the past few years. And as we can see, the dividend has been increasing by about 6.16% annually and has increased by more than 100% over the past 10 years. Now moving to our first valuation model, the historical price to FFO model, we take the historical price per share, the historical FFO per share, and get our historical price to FFO. We then compare that to the current price to FFO and get an intrinsic value of $214.25, showing that ARE is currently undervalued compared to what it has been trading in the past. Now moving to our multiples valuation model, we compare ARE to BXP, KRC, and CUZ. We take these companies' stock prices, their FFOs per share, and get their prices to FFO, which we then average out and compare to the price to FFO of ARE. And we get an intrinsic value of $80.32, showing that ARE might indeed be overvalued when compared to the companies which operate in the same sector. Now moving to our final valuation model, we take the dividend payout over the past 5 years and calculate the average growth rate to be at 5.75% annually. Now due to the very high trailing payout ratio of ARE, I believe that their dividend growth rate will have to decrease slightly. So I will predict a projected growth rate of 3% over the next few years. And as we can see, that will give us an intrinsic value of $175.75. Again, quite higher than the current trading price of Alexandria Real Estate. Now finally, moving to our ultimate valuation, we average out the 3 valuation models and get an ultimate intrinsic value of $156.77, 35.79% higher than the current trading price of the company. Now if you plug in a margin of safety of say 20%, that would still be a buy at $125.42. Personally, I do believe that both of these companies are worth investing into, but of course, before putting any money into any company, you should always do your own research. With that, if you like these spreadsheets, you can download them at my Patreon at the link in the description. Make sure to leave a like, consider subscribing, and let me know down in the comments which company you would like me to evaluate next.